Hi, I'm Leena Rao here with this week's Ask a VC show. I'm here with Rob Coneybeer, Managing Director and co-founder of Shasta Ventures. Thanks so much, Rob, for joining us here.
Yeah, I'm thrilled to be here.
Yeah, so I guess let's start out with talking a little bit about what you do at Shasta. What are your concentrations and what are you investing in right now?
So as a firm, we focus on early stage IT. So our focus is on Series A investment. So we do an occasional seed investment, occasional Series B. And we focus on mobile and wireless. We have a very active SaaS and enterprise software practice. And we also look at e-commerce and traditional consumer internet businesses as well.
So tell me a little bit about what you're specifically excited about right now.
Yeah, so I'm very excited about the intersection of the real world and the internet. And I think of that as being enabled by all the things you see going on in mobile and wireless right now, which is what I cover at a very high level right now. Within that area, I think of it as having two major opportunities. One is where you have the smartphone, and you think about 1 billion people around the world that have either an iOS device or an Android device, and using that as a key to unlock big offline markets. So if you think about transportation, if you think about what's going on with TaskRabbit, where we're an early investor, unlocking labor markets, if you think about Cherry, where we're also an investor, unlocking the car washing industry, these big multi-billion-dollar businesses, that's one direction. The other,
is that collaborative consumption?
Collaborative
that's like
consumption
the new
is
buzzword right
yeah,
now.
collaborative consumption is a big part of that. So it's collaborative consumption in terms of thinking about sharing fixed assets, but it's also collaborative consumption in thinking about how do you have an on-demand workforce where people can plug into those opportunities, such as TaskRabbit, and work for a few hours a week, or if they want to work 60 hours a week, whatever they want to work to make money. So it's both, and we think that's unlocked by the smartphone, that it really enables that. The other area that I think about with the intersection of the real world and the internet is internet-powered hardware. And a great example of that is Nest, where we were an early investor in the company. I led our Series A investment when there were 10 people working out of a garage in Palo Alto. And it's where you have a piece of hardware that unlocks a huge opportunity for consumers to save money in their home, the thermostat.
Right, exactly. So, and just let's go through what Nest does. It's a device where you can actually control your heat, your AC via your phone, correct?
Right.
And it sits on top of your existing thermostat, or do you need a new thermostat? Do you have to have a thermostat?
Yeah, what you do is you replace your thermostat, and it's very easy to do. You pop your old thermostat off the wall, and they have a process, and typically it takes about 5 to 10 minutes to install it. And if you look on YouTube, you'll see that there's 8-year-olds and 70-year-olds that videotape their installation process. It's that simple. But what's unique about Nest is it's built-in machine learning. And what the machine learning does is it learns from how you use the thermostat, and it programs itself for you. And we think that that is part of the huge power of internet-powered hardware that's coming, is not just devices that look beautiful, but devices that learn from you and get better with time. So one of the really unique things about Nest and that class of devices is that the longer you have it, the better it gets.
Right.
Which is really unique. If you think about Darwin,
it starts learning. It starts understanding
exactly.
and figuring out what the best ways to save money and be energy efficient for
exactly.
your needs.
Exactly. And what's exciting about that is that that device gets better with time. So if you think of Darwin for devices, it's almost like if you remember having a baseball glove, and the baseball glove wears in, breaks in, and it gets better the longer you have it. And it used to be that hardware devices that consumers would buy, they become obsolete. You'd buy it, you get it out of the box, battery life would get worse, it would start to become decrepit, obsolete. But what's changed is because these hardware devices are connected to the internet and they're incorporating machine learning, they actually get better the longer you have them.
So one of our audience questions was, what sector are the next wave of disruptive companies going to be in? I'm curious, it sounds like you've highlighted collaborative consumption, these sort of intelligent hardware startups and opportunities. What else? Is there anything else you feel like, in 2013 that we're going to see a lot more of?
Well, I think that you're going to see innovation in a lot of areas. One area that we care about a lot as a firm is we have a huge dedication to software as a service companies, and we've invested in a bunch of companies there. We think there will continue to be more. We are early investors in Lithium, Spiceworks, Aptio, Zuora, which is on-demand billing for subscription services, and we think that's an area where we'll continue to see a lot of growth. Within mobile and wireless, we do think that internet-powered hardware and going from online to offline will continue to be huge areas going forward. And I think pushing that forward, you'll start to see opportunities in and around robotics and a lot of areas where traditionally there haven't been great businesses built, but we think that that whole equation has changed pretty dramatically. And we think that when you look at Kiva Systems that was acquired earlier this year
Amazon, right?
by Amazon for, I believe, around $700 million. You take a look at iRobot, which is a public company that continues to perform well. I think that there will be some companies either in drones, 3D printing, et cetera, where there will be a lot of innovation coming in 2013 and 14.
So you've been a VC for some time now. How?
16
Nearly
years.
20 years, right?
Yeah.
16 years. So David has a question, and I wonder if you'd agree with this. Do VCs have a short attention span?
I think that's a great question because there's VCs across the board. I would say one of the things that has changed dramatically is the entire VC landscape over the last 16 years. So I came in '96. I was at NEA for 8 years, focused completely on communications and networking. And I think that when people look at the industry and look at investors, there's a lot of inquiries that people get when they're focused on an area. So literally, we could get hundreds of inquiries, hundreds of opportunities. So to any individual entrepreneur that may be coming in, it may feel like, hey, is that a short attention span? But at the same time, what we're looking for is where can we be really helpful with the companies? And those are the areas where we go in and focus and spend a lot of time. And where I spend probably about a third to a half my time is working with companies we've invested in. And when we dive in and work with a company, I'd say we have a very high level of focus, and that's where we'll go really deep and spend a lot of time with a company. So I think that when people ask the question of short attention span for a VC, a lot of it is the difference between looking at new investments and working with current investments in the portfolio.
Yeah, so you mentioned, you spent some time at NEA. Then you went on to found Shasta Ventures. So
right.
Why did you feel like there was a need for another VC firm on Sand Hill Road?
It's interesting. I think that question is a question that most founders, when they start companies, no matter what they're doing, they're asked.
Right.
Like, with Tony Fadell and Matt Rogers when they started Nest, why does the world need a new thermostat? Or when Jim Barton and Mike Ramsey started TiVo, which was originally called Teleworld, why does the world need another programmable VCR, et cetera? So I had been at NEA for 8 years. It was 8 great years while I was there. But I wanted to spend a lot more time focused on consumer-facing businesses. And most importantly, I didn't want to go through my career in Silicon Valley without starting something from scratch, from absolutely nothing. And I can tell you from going through that experience, working without pay for over a year, going out and pitching limited partners, if entrepreneurs ever think that it's challenging talking to VCs, I can tell you that the difference between that kind of that knowledge gap and VCs to LPs is another order of magnitude altogether.
What is that like? Because you've worked at startups, you've kind of seen both sides of the equation. So what's it like? What's the comparison? And
well, like
what's it sounds a very intimidating.
Well, I'd say a couple things. One is you have to travel a lot, so you're getting on planes all the time. We had over 120 first-time pitches that we gave to prospective investors when we raised the first fund, and any entrepreneur that's gone out and raised money from scratch and has been challenged in that process knows what the call is like when you get a call from somebody and they say, hey, we can meet with you tomorrow at 2 o'clock. And that person might be in Chicago or New York. And you say, hey, what a coincidence. I'm going to be in Chicago tomorrow at 2 o'clock. And of course, you hang up the phone and then you go and you book the tickets to go and fly to see that investor. And you bring this energy level, you work to bring this energy level to every one of those prospective pitches that you have, regardless of what you might have heard. You might have heard mixed things about somebody, but you come in and you say, I'm so thrilled to be here. I've heard great things about you. I'm really excited to be here. Because what you find is sometimes what you heard in advance wasn't true. Sometimes it was. But you need to raise the money and you need to get into business. And I can tell you from having gone through the experience of working for a year without pay, starting something from scratch, when everybody's saying, why does the world need another venture firm? It's a humbling experience. And I think it's an experience, that capital formation experience, that is a useful driver for every entrepreneur and every founder.
Yeah, well, I think that, certainly the lessons you must have learned are things you could pass on to your portfolio companies. I want to take one more question from our audience. From Nikhil, what do you look for in a startup to invest in at a seed stage? Is it important for you that the startup is already generating revenue when they start looking for seed funding, or do you just need a solid business plan?
Sure. Well, as a firm, we're very focused on Series A. We do some seed investing opportunistically. We do some later stage investing opportunistically. Each year, personally, I make about 1 or 2 seed investments. So when I make the seed investment, it tends to be in an area that I think is particularly strategic and interesting. So about a year and a half ago, I led our seed investment in Criticism. And Criticism started out by doing crash reporting for iOS and Android, which we thought as a firm was a very interesting strategic place to be. Simple problem, simple proposition in an area where I have a lot of expertise and understanding because we've gone deep in that area. Loved the founders, loved what they were doing, and decided that was something that we'd like to do. So for us, when we think about seed investing, it tends to be in an area that we think is strategic and directly related to what we're doing. But when we make a seed investment, we view it as a serious, significant investment, as opposed to making 30 investments in seed stage over the course of the year. Each of the partners might do 1 or 2 if it's an area that they're particularly interested in and can add a lot of value to.
So are you looking at business plans? Are you thinking about revenue? Because,
the way that I tend to think about businesses when I look at businesses is, how are they adding value? How are they adding unique value? And I think for consumer-driven businesses, which is an area that I spend a lot of time with right now, if you're delivering value and the consumer has a great emotional attachment to what you're doing, business models will emerge and you will get paid. That can be a challenging process to go through to figure out how to do that. And we're always thinking about how could we charge for what we're doing. But a really critical element that we think about is, how are you serving the consumer in a way that they value? And if you're able to serve that consumer, and you'll notice I don't say capture, exploit, derive value from, but really serve, then you can build an attachment that each of those consumers will want to promote you. You won't even have to think about social media, because if those users love your product, they will promote it to other people through all the channels that are available. And candidly, at the earliest stages, we think about how big the market could be and what the opportunity is, but not a lot of time thinking about, in a consumer business that is, exactly what that model might look like.
Well, Rob, we unfortunately are running out of time, but thank you so much for coming in, and we really appreciate you telling us about your investments and your strategies, and hopefully we'll see you again soon.
My pleasure.
Thanks so much.